Says we're live. Kia ora, everyone. I'm Bernard Hickey from the Kaka, here with Craig Rennie, who has a wonderful Substack and is also the chief economist at the CTU. Craig, lovely to see you.
Thank you for having me, Bernard.
It's been a big day in New Zealand's political economy with the surprise resignation of Adrian Orr, the Reserve Bank governor, announced just before 2 o'clock today, in which he said he was leaving after 7 years in the job, 3 years earlier than the normal ending of his second term. He did not give a specific reason for going, and neither have Nicola Willis, the finance minister, or Neil Quigley, the chair of the board. So there's plenty of speculation around, and I'm not going to go into too much of it because, frankly, life's too short. So, Craig, you were in an interesting position, particularly in the first couple of years of Adrian Orr's time as Reserve Bank governor, and obviously watched closely what happened through COVID. What's your feeling about Adrian Orr's, the criticism about Adrian Orr, particularly around monetary policy through COVID, to start with?
Well, first of all, I would like to say I'm as surprised as anybody else by Adrian's departure. Like you, I thought he had another 3 years in office. He seemed very keen to take the job when he took the job 7 years ago. But as I think you've alluded to, he's faced a lot of criticism along the way. Much of that criticism has seemed at times unnecessarily personal, rather than actually being related to his job or how effective he was. And it seems related to much to the change in the culture that he was trying to bring to the Reserve Bank as much as anything else. In terms of the criticism of his monetary policy, the first thing that we, of course, need to reflect is the fact Adrian's the governor, but he's the governor in a committee, in a monetary policy committee. There are 4 Reserve Bank staff, 3 external staff, and a Treasury observer who sits slightly to one side, usually. And so decisions made by the committee are made by all 7 members of that committee. So monetary policy, if there is to be blame anywhere, needs certainly to be shared amongst that committee. For much of the period of Adrian's time pre-COVID, the key challenge was actually getting inflation up and struggling to lift inflation, to lift activity. During COVID, rapid cuts were made to interest rates. That's not unique to New Zealand. That's something that occurred right around the world. And we made, and both reserve banks and governments made easy money available to support liquidity in markets, in the fear at the time that essentially markets would collapse. We didn't see those markets collapse. The question is whether or not the Reserve Bank acted strongly enough at the beginning, but also whether or not it acted strongly enough to actually withdraw, the monetary policy settings that went up to 5.5%. We were the second fastest country in the world to start putting interest rates up after the Norwegian central bank. The rate of increase was arguably the fastest of any of the developed reserve banks in the world. The real argument for me is whether or not we were withdrawing that interest rate cuts, simply because the effects right now seem quite stark. Both our interest rates are still higher than many other jurisdictions, and our inflation took much longer to fall than in other jurisdictions, suggesting that the sensitivity of our inflation to interest rates wasn't as strong as perhaps elsewhere. And again, if there's any criticism to draw, it's whether or not we left those interest rates too high for too long, and we've ended up with the recession that we now find ourselves in.
Do you think that it's fair to say that the Reserve Bank and the government caused inflation to go up to 7-8% or whatever it was, and
Um,
that the Reserve Bank governor and the government of the time, Labor, should take responsibility for that inflation?
um, Adrian Orr, in his role as a powerful man, he has many powers and levers at his control. The government is very powerful. It's not responsible for global shipping prices rising 1,100% in 1 year. It's not responsible for oil prices nearly doubling in a year. It's not responsible for insurance, for a range of other factors rising very rapidly during COVID, when we saw essentially what was a supply chain shock. And that supply chain shock then delivered the first round of tradables, if we all cast our minds back to that, inflation. And that tradables inflation was always going to feed through to non-tradables inflation, to services in New Zealand. um, the extent to which we should have been using solely the interest rate lever as a means of tackling that problem, that's very arguable. There's plenty of things we should and could have been doing along the way. And I think it's very difficult to blame Adrian in particular as an individual, but also the Reserve Bank as being responsible for the slowdown we find ourselves in now, and certainly not for the inflation that we found ourselves in then, because inflation was found in every developed economy around the world.
There is the argument, though, that there was more than just cutting interest rates in 2020. The Reserve Bank effectively printed money to buy government bonds, at least initially to stabilise the bond markets, which were completely frozen, but also kept buying those bonds through 2020 and well into 2021. It also removed the loan to value ratio controls and provided very cheap lending to the banks
Mm.
through the Funding for Lending program, which in combination, very low interest rates, very easy credit for the banks, and the removal of LVR controls did contribute to that explosion in house prices in 2020, 2021, which, in a nation where most people's wealth is determined by how high their house price is, did seem to play a role in the inflation. Could the Reserve Bank have loosened without firing up the housing market?
I think you're right to distinguish between consumer price inflation, which is certainly what most people were concerned about, and house price inflation. And I think there is an arguable case for the Reserve Bank not being as agile or as thoughtful about certainly some of its capital programs and the liquidity programs, and the effect that that would then have on the housing market and the availability of capital in what essentially was a very supply constrained market. We were already tens of thousands of units housing short in New Zealand. We had a rapidly rising population. You put more fuel, more money into that market, you deliver more inflation. On the consumer side, it's a much more difficult case to make that any of that loosening then led through to the price of cheese going up, or to the price of other goods and services rising. So I think the challenge there is that the Reserve Bank governor found himself between a rock and a very hard place, because many of the tools to tackle that problem, or the housing problem, are actually long term and supply based. They are about building more housing. They're about allowing the consenting of more housing. They're about having a construction workforce. They're not about the short run things that the Reserve Bank governor could have done at that particular point in time, when, if you all remember, they were throwing the kitchen sink at making sure that the economy didn't fall over at that point, which was the worry, not just in New Zealand, but around the world.
Yeah, I mean, it is a curious thing. Immediately after the COVID crisis, when inflation was starting to take on, the opposition, the then opposition, now of course the government, were very, very critical of Adrian Orr personally. And to be fair to them, he always took the criticism very directly, and you could argue he might have had a bit of a thin skin here and there. Do you think that the other things that he did, as well as the monetary policy, so for example, his embrace of Te Ao Māori in the Reserve Bank, the expansion of the Reserve Bank to include more regulators, and do you think that has played a role in the sort of noise and the heat around his particularly his reappointment for a second term, which caused quite a lot of drama in 2022.
I think certainly one of the things Adrian was very keen to do right from the get go was to put the Reserve Bank properly in its place in New Zealand, to see all parts of New Zealand reflected inside the Reserve Bank. Hitherto, and I say this with love as a former Reserve Bank employee, it was quite a technical, dry institution that not many people entered and fewer people knew what was going on inside. Um, and Adrian saw the Reserve Bank as not only having something important to say to New Zealand about your financial sector, but also he wanted to see all of New Zealand able to see itself in the Reserve Bank. And I think there was a lot of particularly unfair criticism about diversity programs or the use of te reo and other things in an institution which is supposed to reflect everyone in Aotearoa. So I think a lot of that was very unfortunate, and a lot of it was aimed at Adrian in particular. Whereas the we would hope that institutions as important as the Reserve Bank were working with every sector of New Zealand society and reflected New Zealand back at themselves and their place in both the government and wider society.
Just we've also got to remember that this controversy and criticism didn't really just start with COVID. In his period from 2018 to 2020, his main, focus was to toughen the capital regulations for the banks, in effect, forcing them to double the amount of so-called tier one capital that they have to hold against all their loans. So with banks, you lend $100 and you have to put aside. Typically, during the global financial crisis, it was only two or three of your own dollars. Well, New Zealand was always a little bit better than that. We always had more like $5 or $6. But under Adrian Orr, the plan was to raise it well over $10 for every $100 you have out there. And from a bank profitability point of view, that means you have to put your money aside into what you think is a low return asset for quite some time. It also essentially restricts your ability to leverage, to increase the size of lending that you do. And it became quite heated, the debate between the Reserve Bank and the banks, particularly the big four Australian banks, in part because he was saying they needed to be able to handle a 1 in 200 year crisis, and they were saying, "Oh, that's a bit gold plated. We only should be forced to have enough capital for 1 in 100 years." What did you think about that push by Adrian Orr to get the banks to put aside more capital?
It's always a tightrope. You want to deliver a big part of the central remit of the Reserve Bank is to deliver financial stability and to deliver financial services stability. Now, on the one side, the banks will legitimately claim if you put these core capital requirements in, that will mean less lending. That will mean lower levels of economic activity. That will mean fewer houses being built and fewer mortgages being provided. Okay, fair enough. On the other side of the ledger, the big four banks alone made nearly $7 billion in profits last year. So I think they'll be okay. There's an opportunity here to make sure that they're actually helping to fund their own stability. Um, and to make sure that if we need to, that these banks aren't going to fall over in a disaster. And before we think, well, there's not going to be a disaster, before the GFC, we didn't think there was going to be a disaster, and then there was one. Before the Asian financial crisis, there was never going to be a disaster, and then there was one. Before COVID, there was never going to be a run on the banks, there was never going to be a crisis, and then there was one. There's always a need to make sure that banks will pass sufficient stress tests so that they're able to stand up on their own 2 feet in any disaster. And I think what the Reserve Bank did wasn't unreasonable, given A, the levels of profits the banks were making, and B, the level of stress that the banks may have found themselves in if, in particular, their Australian parents had walked away from any of their liabilities in New Zealand, because most of the banks are Australian. If any of them had walked away from that, the alternative is the Crown would have been left to hold on to those liabilities, and we all would have paid for that.
Yeah, because everyone forgets, of course, that unlike most other banking systems in the world, during Adrian Orr's time and before, there was no bank deposit insurance scheme. So essentially, the thoughts were, and has been since the late 80s, that the banks had to disclose their performance and their strength, and we let the chips fall where they may. That, somehow we can handle as an economy a bank falling over. And that was always a bit of a fiction, a bit of a nod, nod, wink, wink story, because we all knew that if one of the banks fell over, the state would have to step in. So essentially, the banks were getting the protection of a crown guarantee without having to pay for it. And one of the solutions for that, at least in the interim, until you built up enough money in your term deposit guarantee scheme, was to just simply force the banks to have more capital. That's, if you've got a problem where the car crash is going to be absolutely awful, and you can't easily force the car to be limited in its speed, you just make sure it's got an awful lot of airbags and protection, and essentially that's what the Reserve Bank was doing. uh, One of the criticisms that's come up in the last couple of years is that the Reserve Bank's capital controls and its caution about issuing new bank licenses has been one of the factors in a lack of competition for the banks. What do you think of that argument?
I think the barriers to entry for the banks in New Zealand is the biggest hurdle. The fact that the majority of the market is captured by four very large banks, it's very difficult and normally extremely expensive to enter as a challenger bank into New Zealand. Um, the fact that you haven't seen large overseas institutions, HSBC I think, has just removed the last of its major consumer banking services in New Zealand, suggests that the challenges are actually structural here. And it may well be that actually we need, if you want to deliver competition, to force the breaking up of some of essentially the oligopoly that runs that banking system. We've seen the challenges in trying to capitalize Kiwi Bank. We could put billions of dollars into Kiwi Bank, and it still, frankly, wouldn't be anywhere near the size to start really challenging any of those big banks on many of the services that we want it to. So I'm not sure it's the challenge of banking licenses. There are probably plenty of new institutions that have a new banking license. It's actually about the nature of the New Zealand banking market and the lock-in effect that the big four banks have, and that requires other tools, competition commission, arguably tools to actually manage to change if you want to see true competition in that marketplace. Because right now, what's certainly the case is that those large banks are making returns, and the Reserve Bank's competition study found this, that aren't found pretty much in any other developed economy in the world. I think the return on equity was second only to that of banks in Canada, um, in terms of the amounts of money that those banks are generating. So we want to see a more effective and a more competitive banking market, but I don't think blaming the Reserve Bank for a lack of new licenses here is the problem. The problem is actually the structure, how the banking sector has evolved in New Zealand is the way it is now.
Just finally, now the government goes through a hunt for a new Reserve Bank governor, and it's quite possible that may not materialise for another 6 to 9 months, which is getting within a year of an election. What are the risks here for the economy of the appointment of someone who has quite a different view on both monetary policy and prudential policy to Adrian Orr?
Well, hopefully we won't see, and the last thing the financial system wants to see are very significant swings in in those sorts of policies. Generally speaking, you want to any change that you make in that space, you want to both transmit well ahead of time and telegraph what it is exactly you're looking for as part of that change, long ahead of actually making those changes. The real risk is that we see drift if we head into another cost of living crisis, where inflation starts to rise again, um, because we don't see, because the US tariffs and other things start to lift global inflation, and the New Zealand system starts to fall, so it starts to follow that global rise. If we see that, then that will be a real risk to New Zealand. So I hope that they will appoint soon and find someone to fill that role. Um, it's sufficiently well remunerated that I hope that there won't be a shortage of candidates. Um,
We should put our
and
hands up. We should put our
well,
hands up,
as
Craig.
I was gonna say, for the benefit of the tape, Bernard, I'm not available. But in terms of the the role, I think there'll be no shortage of good, high quality candidates who will be able to do the job. The key thing, actually, going forward, is making sure that both monetary policy and fiscal policy are working together. And arguably, during the last government and the Labour government, we saw fiscal policy on the accelerator and the Reserve Bank on the brake. Now we see the Reserve Bank on the accelerator and the government with through fiscal policy on the brake. And actually, we want to see actually these two things working properly in tandem rather than working a counter to each other, which essentially is where we've ended up now.
Yeah, that's a great point. There's always talk about reform of the Reserve Bank and people trying to put new mandates in and putting committees in instead of single decision makers. And there has been discussion about some sort of, fiscal monetary policy council coordinating thing, but we're still no closer to it. And, you could argue, particularly at the moment, but you're right, maybe in the last year or so of the Labor government, that they were the rally driver who had one foot on the accelerator and one foot on the brake, and the navigator in the seat next door also had feet on both as well. And it was ugly, right, left, no, forward, back, gee. And we are where we are. Thank you very much, Craig. I really appreciate your time and waiting. This has been a bit of an experiment, and I see we've got over 100 subscribers to the Kaka listening in. We might do this again, depending on how people think, and we'll be able to put this up as a video for those people who are busy with their dinners tonight. So thanks again, Craig. I really appreciate the time.
Thanks for having me.
Cheers.